Okay, hello ladies and gentlemen, and welcome to this webinar brought to you by City Index. This is how to interpret common chart patterns, and this is part of our weekly series, our weekly ongoing series every Wednesday at 8 o'clock UK time, UK time, we're going to be talking about different aspects of your trading. Last week we talked about technical indicators, and today we're going to be talking about common chart patterns, and just another one of very important elements of your trading that you should take into consideration. Now, these webinars are ongoing. So far we've held two, to answer your question, Rick, and we are continuing on for the next many weeks on an ongoing basis. And again, these are recorded, so if you have any, if you happen to miss a webinar or you just want to go over it again, you could certainly go back to our webpage where you signed up for this one, and the next day or the day after that, it should be posted onto the website, so you could go ahead and view the recording at your leisure. Okay, so let's move forward real quick. First, a quick disclaimer. Financial trading carries a high level of risk to your capital with the possibility of losing more than your initial investment and may not be suitable for all investors. Ensure that you fully understand the risks involved and seek investment advice if necessary. Okay, just a few seconds with that, and then we're going to move forward. Okay, again, my name is, maybe not again, but I didn't mention my name. My name is James Chen, for those of you who have not attended these webinars or reviewed the recordings. I am the Chief Technical Strategist with City Index Group, and what I do is I trade, I analyze, and I educate, much like what I'm doing today. So, and this is a bunch about me. I've been trading the markets for a long time, all the different markets. I trade Forex, commodities, equities, indices, futures, etc. And I use primarily technical analysis, which, that's going to be the main focus today. It's not the main focus of every single webinar that I give, but it is, one of my primary focuses because that's the way I trade on a daily basis. Okay, so let's move forward real quick. As I mentioned before, we did two webinars prior to this, Introduction to Trading Currencies, Indices, Commodities, and Shares, a very basic webinar. Then we moved on to last week, the best indicators for technical trading. Today we're talking about common chart patterns. And I have a lot to say about that, and it's it's going to be very interesting. And if you have any questions, please feel free to type them into the questions window. Next week we're going to be talking about multiple time frames when analyzing charts. And then we're going to go on to high probability trade entries, and then we're going to be talking about exits in the form of stop losses and profit targets, and then we're going to be talking about emotions and trading psychology, and the 8th week is going to be trading plan discipline. And again, this is an ongoing series. I just have the titles for the next 6 webinars, but we're going to be filling those in as we move forward in the weeks. Okay, so let's move forward real quick. Let's talk about chart patterns. Now, basically, what are chart patterns? Well, what chart patterns are, if you've ever heard of anyone say they want to trade based upon pure price action, as opposed to trading based upon technical indicators or what have you, then a lot of times they're talking about chart patterns. Okay, so chart patterns are basically you're looking at the charts and you're finding patterns in them, and you're looking for price action moves around those patterns. Okay, so basically chart patterns tell you what's going on in the market, how the traders are reacting to different events. If you find consolidations in the market, breakouts in the market, etc., those will all be shown in the form of chart patterns. Okay. Now, I talked a lot about this in my prior 2 webinars. We talked about technical analysis being less about predictions and more about trading and triggers and risk management. Well, this really fits the chart pattern way of trading, because really what you're looking for are triggers to trade, triggers to enter into trades, and triggers to get out of trades. And chart patterns can help you tremendously in that respect. Okay, and this really goes along with what I talked about last week in terms of the indicators. You put all your tools together in terms of, what I talk about a lot is confluence. You have your indicators saying one thing, you have your chart patterns saying another thing, you have your trend lines saying another thing. If they all come together and are saying the same thing, that is confluence, and that's they're confirming each other, and therefore you're getting what I would deem a higher probability trade. So that's why I'm presenting all these tools to you, and only a handful of tools in each subject. So in terms of the chart patterns, I'm only going to be talking about a handful of tools, what I really turn to on a daily basis to help me in my trading. I put this together with my indicators, I put this together with my trend lines, as well as the fundamentals of any market. And then I look for high probability trades. I'm trying to put all my edges together to create those high probability trades. Okay, and another thing before we move forward with the chart patterns is that, just like the indicators, I talked about this last week, just like with the indicators, that no one indicator is an end-all or be-all. Okay, so you want to be able to give yourself an edge in trading. You want to put it together with your other tools that you have. Now, that being said, I do know some people that trade based upon, one or two chart patterns almost exclusively. I wouldn't recommend this. I mean, a lot of these traders have a lot of experience doing this, and basically they study one chart pattern and they study it to death, and then they sort of get a feel over the years, over their experience, how price action moves around these chart patterns, and they're able to trade based upon that. But most of the time, these successful traders that do this also have very good risk management skills, and they're very good at entering and exiting trades. So not only, I wouldn't recommend for any beginners out there to be using one chart pattern, one or two chart patterns to trade exclusively based upon those. But I would really put together all the tools that you have to make it into as high probability trades as you can make it. Okay, and we're going to be talking a lot about risk management and trading plans and discipline and all that in the weeks ahead. So let's move forward real quick. So what is chart pattern trading? Well, there's a huge variety of known chart patterns. If you ever read that book by, I believe his name is Thomas Bulkowski, it's an encyclopedia of chart patterns. It's been around forever. Now, this book is very thick. It's got a lot of chart patterns in it. Now, I really wouldn't, I had to go through all that, but I really wouldn't recommend, going through that and memorizing it, because really all you need is the experience to trade with a handful of chart patterns, okay? So as I mentioned, only a handful are actually needed. Many of these patterns are very similar to each other. One of my main patterns that I use is the flag or the pennant. They're sort of interchangeable for me. The flag and the pennant basically are telling me a story. Just like all the chart patterns are telling me a story, the flags and the pennants are telling me the story. What is the story they're telling me? They're telling me that price action is consolidating. Maybe it's pulling back a little. I'm looking for the breakout back in the direction of the trend. That's all it's telling me, okay? Now, you could say a triangle is a different pattern. You could say a wedge is a different pattern. But basically, to me, they're all the same thing, okay? What is the story they're telling you? The story they're telling you is that, again, you have a move, okay, whatever direction that move may be. You've got a consolidation or a pullback, and then you have a continuation of the move. And I'm going to go through this in a minute. Those are called continuation patterns, okay? And I use those very, very extensively. I'll show you on my charts in a minute. Okay, so chart patterns generally describe consolidation, as I just mentioned, and support and resistance. When it comes down to it, what is a chart pattern but support and resistance? What is support and resistance? They're levels or price levels in a market where you have demand or supply, okay? So when you have support, you have demand. When you have resistance, you have supply. So support is sort of like a floor, if you want to think of it that way, and resistance is sort of like a ceiling for price. It doesn't necessarily mean that there's not going to be a breakout above the ceiling or a breakdown below the support. I mean, that's actually what we're looking for, okay? But generally speaking, when you talk about defining support, you're talking about a floor. you're talking about demand at that level. When you're talking about resistance, you're talking about a ceiling or a ceiling or supply at that level. Okay, for those of you who are new to this. Now, usually chart pattern trading involves looking for pattern breakouts, like I just mentioned. So when you see a triangle, when you see a flag or a pennant, which I'm going to show you in a minute on my charts, what you're really looking for is a breakout. Same with the reversals. Okay, same with the reversal patterns like the head and shoulders, the double tops, triple tops, etc. You're looking for breakouts. Okay, that's basically what you're looking for, and you're looking, they're in different directions. So for the reversals, you're looking for a reversal breakout. For the continuation patterns, you're looking for a breakout in the direction of the trend. But any way you look at it, you're looking for breakouts. Okay, continuation patterns depict consolidations and breakouts, as I just mentioned, in trend breakouts in trend direction. So I talked about TPB, or trend pullback breakout, on my first, the first webinar in the series 2 weeks ago, and I'm going to show you that again in a second. But basically, what continuation patterns are just this, okay? You're looking for consolidations, you're looking for breakouts in the direction of the trend, and that dictates oftentimes your trigger to get into a trade, your entry into a trade. Continuation patterns include triangles, rectangles, flags, pennants, wedges, okay? These are all continuation patterns. As far as I'm concerned, they're pretty much the same thing. I'm going to show you all of them, but it's the same story that they're telling. Okay, continuation patterns are the same story. Consolidation. First, you have a trend, then you have consolidation, then you have a breakout in the direction of the trend once again. Reversal patterns, on the other hand, depict failed trend moves and subsequent reversals. Okay, so when you see a double top, you see a head and shoulders pattern. I'm going to show you a bunch of head and shoulders patterns in a second, but when you see a reversal pattern like that, okay, basically they're failed trend moves and they're reversals, as the name would suggest. Okay, so price action is turning to the other side, and we see this all over the charts. Whether you look on a long-term chart or a short-term chart, we see reversals all the time. Reversal patterns include double and triple tops and bottoms, as well as head and shoulders, and there are many more. But I'm only talking about the ones I use on a regular basis. These are the most basic, and as far as I'm concerned, the most useful of the chart patterns. Candlestick patterns are another type of, so now we're talking about candlestick patterns, which I'm going to introduce after I talk about these chart shapes. Candlestick patterns are another type of chart pattern that describe the conflict between bulls and bears. So when you see for example, a doji or a hammer or a shooting star or any of those very imaginative names, basically what they are they're sort of, you could think of them as micro chart patterns, okay, very small chart patterns that give you some idea of the short-term conflict between the bears and the bulls. Okay, I'm going to introduce some of the very, very useful candlestick patterns that I use on a daily basis. Okay, so let's move forward and let's talk about these patterns, and I'm going to show them on my chart as well. Let's first talk about the flags and pennants. I talk about these all the time. Why do I talk about these? I mean, just look at the shape. Okay, so we have the flag pole or the pennant pole, but it's basically a flag pole. So we have a flag pole. We have a consolidation in price. We saw this on the euro dollar, for example. We see this all over the place. Okay, in all the different currency pairs, the indices as well. Not right now in the indices, but you see this on stock charts all the time, on commodities, all over the place. Okay, so these are extremely useful patterns here. So you have the flagpole, which represents the prior trend, and then you have the flag part or the pennant part, which represents the consolidation or the pullback. Okay, in this case, it's a slight pullback and a consolidation. Then all you're looking for is the breakout in the direction of the trend. Okay, and this could happen to the upside or to the downside. Same thing to the downside. Pennants are exactly the same thing, just a slightly different. Slightly different shape here, but it really doesn't matter. It's telling you pretty much exactly the same thing. Rick, what is the difference between pennants and asymmetrical triangles? They're basically the same thing, okay? So I'm going to show you triangles in a moment. Pennants are just, a lot of people, a lot of technical traders and analysts will say that pennants are just small triangles, which is basically what it is, but they're triangles nonetheless. So they're triangles on a flagpole. And what is the flagpole? The thing with these names and everything, it tends to throw people off. What I would do is really look beyond the names and the labels and look at the story it's telling you, like I mentioned before, okay? So you talk about this pennant and how is it different from a triangle. It really isn't. I mean, a pennant could be, it's a smaller consolidation, okay, after a price move to the upside. So it's a price move to the upside, in this case right here, and then it's a consolidation into a small triangle, and then it's a breakout, okay? It's trend pullback breakout. Same thing to the downside. Okay, and I told you I would show you the TPB again. For those of you who saw it, let me just go through it very, very quickly. TPB, trend pullback breakout. That's what I'm looking for whenever I'm looking at any market that I'm trading on any time frame that I'm trading. I'm looking for the trend, whether it be the long-term trend, as we can see on the, for example, the euro dollar, the Aussie dollar, or even dollar yen or what have you, the longer-term trend, or the very short-term trend that you could see on an intraday chart. We're looking for the trend, okay? We're looking for the pullback, and this pullback can be in the form of a triangle. It could be in the form of a pennant, a flag, whatever, a wedge, a rectangle, whatever you want to call it. It's a pullback. It's a consolidation before a continued move in the direction of the trend. That's why they're called continuation patterns, okay? So trend, pullback, and then here I have the little blue line for a breakout. So you're playing that breakout out of that chart pattern, okay? And then once you play the breakout on your entry, you have a stop loss under the low of the pullback, okay? So in terms of the pennant or the flag pattern, this would just be maybe the low of the flag or pennant. Okay, you would place your stop loss, and then you play that breakout, and then you have your profit target from there. Now, just to go over quickly the targets on these. A lot of people will talk about targets. You have this flag pattern, for example. And then once you have the breakout, you would simply extend the height of this flagpole up to the upside, and you would get your target. I don't really subscribe to that type of trading because it is a little bit arbitrary, and oftentimes you'll see that it doesn't really work out the way it's supposed to. So instead of doing that, I have other ways to target my profits rather than to use these, for example, use these flagpoles, etc. Okay. But you could certainly try that. You could certainly try that as maybe your first goal or your ultimate goal, your ultimate target being to get the length of the flagpole, what have you. Okay? Okay, triangles. Now, to get to triangles, Rick, what you were talking about before were the asymmetrical triangles. You have a symmetrical triangle and you have asymmetrical triangles. Okay, so the asymmetrical triangles are basically ascending or descending. Now, what is a symmetrical triangle? And all it means is that the upper border of the triangle is pointing to the downside, and the lower border of the triangle is pointing to the upside. Okay, they could be at different angles. It doesn't have to be exactly like this in order to be called a symmetrical triangle. It just means that you have the top border moving down, you have the lower border moving up. Okay. And then for an ascending triangle, it's simply the top border is just a straight resistance line. It's just horizontal, and then the lower border is moving to the upside. Okay, and for ascending triangles, that's usually it's usually said to be biased to for a breakout to the upside. Okay, so oftentimes you'll see here this ascending triangles are after moves up. Okay, within uptrends. And then descending triangles are after moves to the downside or downtrends. So here, a descending triangle here, you have a horizontal lower border, and then you have a descending upper border. Okay, and that's biased to the downside. But really, you'll find that these triangles can break either to the upside or to the downside. What I usually say is that I'm more concerned with what happened before the triangle than I am with the exact shape of the triangle. Okay, so you'll very rarely see triangles form exactly like in a beautiful manner. Okay, you'll see some of them, but very rarely will you see them exactly, to the line. But basically the story is still there, that you're looking for the prior trend, you're looking for the momentum in the market, you're looking for consolidation, pullbacks that represent profit taking, for example. Okay, and then you're looking for continued momentum in the direction of the prior trend. Okay, and that really applies to all types of triangles. So, I really don't like to give these names to all these triangles, because basically for me they're all telling the same story. After trend and a consolidation, you're looking for a continuation of the trend. Okay, and we can see this all over the charts, which I'm going to show you. Okay, rectangles and wedges, same thing. Okay, how is a wedge different from a triangle? That would be a good question to ask. My answer would be it's really not. Okay, the technical difference between a wedge and a triangle is that a triangle, the bottom border is either flat or moving to the upside, and the top border is either flat or moving to the downside, whereas a wedge, both borders are moving in the same direction, to the downside or to the upside. Okay, maybe at different angles like we see here, but they're moving in the same direction. So as we can see with the falling wedge here, we could see both borders moving to the downside. Okay, how does this really matter to you? It really shouldn't matter too much. What should matter more is what happened before. So this, again, the falling wedge is probably the epitome of the TPB, or trend pullback breakout approach. So here we have this trend, we have this consolidation, but really in terms of the falling wedge, it is a pullback. Okay, this is a pullback, and then you have a breakout in the direction of the trend once again. If it doesn't break out in the direction of the trend, then you have no trade. Okay, it's either a continued wedge or a continued consolidation pattern, or it could be a reversal. Either way, there's no trigger to get into that trade if there's no breakout. Okay, so a rising wedge is just the opposite. In a downtrend, you have a pullback to the upside, a consolidation and pullback to the upside, and then you have a breakdown in the direction of the trend once again. Okay, so that's what I'm looking for right there. The wedges are basically the trend pullback breakout approach in a nutshell. Same thing with rectangle. Okay, so instead of a rectangle, in terms of the rectangle, instead of it being a pullback, it's simply a sideways consolidation before a continuation in the direction of a trend. Okay, so here again we have a move to the upside. Okay, and then we have a sideways move, and then we have a breakout to the upside, and that's a continuation pattern. Now, a lot of you may ask, what if it broke to the downside? Well, then it's then there's no trigger to it's not a continuation pattern. It could very well be a continued consolidation, or just a breakdown and then a reversal. So this could be a reversal pattern too. It could be double, triple, quadruple top, as we can see here just from this drawing. But this could either turn it into a reversal pattern or a continuation pattern, depending on where the breakout is, what breakout occurs. If it breaks out above resistance, then it's a continuation pattern. Okay. Of course, there could be fake breakouts, but if it breaks out and it follows through to the upside, it is a continuation pattern. If it breaks down and follows through to the downside, it's a reversal pattern. It's simple as that. Okay. So I know these look very neat and clean, and you don't see this all the time on the charts, but it really depends on where the breakout occurs. Colin, what time scale should one use? Yeah, that's a really good question. As I mentioned last week on my indicator webinar, same thing with patterns. Patterns and indicators and all of these tools of technical analysis are what we call fractal, which means that they occur on all time frames. So whether you are an intraday trader, okay, you're trading short-term time frames, or you are a trader trading the daily chart, longer-term time frames, whether you're a intraday trader, or a swing trader or position trader, it doesn't matter. These tools will work, will work for all of the different time frames. Okay, And what I often say though is I tend to avoid the very, very short-term time frames, including anything under a minute, anything really under 5 minutes, because you see a lot of noise and it's harder to pinpoint charts in those very short-term time frames. But for every other time frame except for the ultra short-term time frames, these patterns tend to work very well because there's less noise, and you're really looking for patterns in the way traders are trading the markets and the way they're interacting with each other. Okay, reversal patterns. We have the double tops, triple tops, head and shoulders tops, and then we have the double bottoms, triple bottoms, head and shoulders bottoms. Okay, very, very simple. What do they mean? So let's take a look at the double top. You have price action hit a high, okay? That's established resistance. It comes back down, it hits another high, okay? And just, around the same area. That's established resistance, and when it comes back down, that's telling you, or it's giving you a story. It's giving you it's telling you what the market is doing. What the market is doing is it's being rejected at that level, at that resistance level, and therefore there could be a move to the downside. Now, how do we confirm that move to the downside? What we as technical analysts do is we wait for a breakdown below the trough of that double top. Okay, this is a trough. These are the peaks of the double top. This is the trough right here. Now, once that trough is formed, we would go short when it breaks down below this support level. That trough represents support, okay? So again, rejection at the highs, it comes down, and then it breaks down below the trough, and we're looking for momentum, continued momentum to the downside to continue this reversal pattern. Same thing with a triple top. Now, one may ask, you've got two troughs in a triple top, so what do you do? Well, generally the rule of thumb is you look for the lower trough, okay, and you look for a breakdown below that level. That is the support level, okay. The lower trough in a triple top would often be looked upon as the support level and the point of breakout, the trigger to get into a short trade. Now let's take a look at head and shoulders tops. This is the same thing, okay. So what is this saying? Okay, basically it's saying price or the market, okay? So it makes the top there, okay? It hits another top, okay? That's even higher than the first one. And then it tries again, but it fails, okay? It fails to make higher highs. It fails to even match the previous high, okay? And that's why it's called a head and shoulders top, because, these are the shoulders, that's the head. So it fails to do that. It gets rejected. It comes down, and then this is right here, this line right here is called the neckline. Very much like the support here, the support here, the trough, okay? So we're looking for a breakdown below the neckline, and there we have it, and that is a trigger to get into a short trade, okay? Same thing to the upside with the double bottoms, triple bottoms, head and shoulder bottoms. We have a peak here, and we're looking for a breakout above there. Now, what is this showing you? This is showing you that maybe price action has bottomed out, okay? Has bottomed out. Same thing with the triple bottom, and we look for a breakout above there. Okay, same thing with the head and shoulders bottom. Colin, 15-minute upwards. Yeah, I would say in terms of the chart patterns, I would avoid the very short-term time frames. I don't even trade down to the 5-minute. I'm more I usually stick towards the higher time frames. Even if I'm trading the intraday charts, I'm going to be looking for a bit higher. So yeah, I mean, if you want to draw a line in the sand, then I would say 15-minute upwards sounds good. I would even go a little bit higher than that in terms of looking for chart patterns. I just don't like to see a lot of noise, and I'd like to avoid that. Because it's very hard to trade from a technical basis based upon noise. If you're a news trader, you thrive on that noise. But as a technical trader, you're looking for patterns in the markets that generally speaking are not conducive to all the noise on the very shorter term time frames. Okay, basic candlestick patterns. Now these are used in conjunction with the shapes that I just mentioned, and basically what they are short-term depictions of the conflict between the bulls and the bears. So again, whether you're on a short-term time frame or a long-term time frame or a middle-term time frame, you're looking for how the market is behaving in real time. And there's no better way to do this than to use the candlestick patterns, okay? So as you're watching price action, let's say on a 1-hour chart or even a 15-minute chart, let's say, you're looking at price action and you're watching in real time how the people who are bullish, or the traders that are bullish and the traders that are bearish, and a bunch of other factors are coming together to form this price action that you could actually trade upon, okay? So you're watching that, and it tends to form patterns, and patterns like these are the main patterns that I will use. There are a ton of different patterns candlestick patterns out there. There's a guy named Steve Nissen that brought candlestick patterns from Japan to the West, okay? And basically, he wrote several books, and one of his books is termed the Bible of candlestick patterns, and it's got a ton of patterns in there, okay? And again, I had to read all that, but in terms of what I actually use on a daily basis, it's very, very few, okay? It's just a small handful. Keep it simple. You don't need all of the different patterns unless those patterns are useful to you. And you're only going to know if they're useful not by reading the description in the book, but by actually looking for it in your charts, okay, and seeing if they are useful. Now, over the many years that I've been trading, patterns and candlestick patterns and chart patterns and everything else, I've come to the conclusion that there's a very, very small handful of candlestick patterns that actually work for me, okay, and I've tried almost all of them. Now, the ones I like are mainly these right here, the hammers and the shooting stars, okay? I also trade the doji and the spinning top. Now, what are these? Basically, they depict uncertainty in the markets and potential reversals, okay? So a doji is simply a candlestick that opens on the left-hand side. I'm sorry, it opens on this line right here, okay? Then it went up to hit a high up here and went down to hit a low down here, okay? Or it went down low first and then went high first. You don't know what happened there, but it doesn't really matter. What you know is that it closed right where it opened, right around where it opened, okay? And that shows indecision in the market. If you have a strong a trend in one direction, and then you have a doji, then you're looking at indecision by the traders, sort of a stalemate, if you will, between the bulls and the bears, and that could mean a potential reversal. Now, like I mentioned last week, I'm not going to be trading based upon a moving average alone. I'm not going to be trading based upon a doji alone. But I put this in conjunction with my other tools, and then that makes for a higher probability trade. Now, doji, a spinning top is very similar to a doji, okay, but it just opens and closes, on at a slightly different price than where it opened, okay. So they're very similar. I believe doji is a stronger signal. But if you're looking for very strong signals, these are the ones to look at right here on the right-hand side, the hammer and the shooting star. I touched upon this, very briefly in the past couple weeks, but I can't emphasize enough that these are very good tools to use in your trading, because what exactly is this telling you? I'm going to be showing you this on the real charts in a second outside of this diagram, but what is this chart telling you? But it's talking all about rejection, price rejection, okay, price failure. So you see the hammers usually occur after down runs, okay, after bearish runs, moves to the downside, okay. So you got these candles. These are black candles. These are showing bearish runs, okay. And then you have this hammer candle that starts off high, okay, and the assumption is that it's going to go lower and it's going to continue this downtrend. However, it goes to its low, and it comes back and closes near its high, and that's called a hammer, okay? And then if this occurs right around a support level, that is a very strong signal that perhaps price is being pushed up by the bulls around support. Remember what I just mentioned before. Support is demand. Okay, not always. Of course, you could have breakouts of support. But if you have strong support, strong demand in the market, okay, and then you have a hammer candle that moves all the way down and then comes all the way back up to get rejected or failing near support, then you have a pretty good idea that perhaps this is going to turn to the upside. Now, will I enter into a trade, into a long trade on a hammer candle alone? Again, I think you know my answer. I will not. But I'm going to be looking for a trigger after this hammer candle occurs. I'm going to be looking for a trigger to go long if it occurred near a support level, because that for me is one of the strongest signals to go long, when you have a hammer candle near a support level, okay? And especially if this is after a pullback. If this is after a pullback and then you have a support level here, if this is a pullback and you have within an uptrend, if this is a pullback, you have price coming down, trying to continue the pullback, but you have support here coming back up and getting rejected here, then I'm looking for a breakout to the upside in the direction of the trend, and that hammer is reinforcing my my outlook or my position. Okay. Duncan, does it matter if the hammer or shooting star is red or green, or in this case, black or white? You know, it really doesn't matter a whole lot. That's a very good question here. In this case right here, this diagram right here, I have a black one. The black ones are depicting the bearish candles, the bearish candles. So here I happen to have a black one. If it was a white one, it's okay too. But if it was a white one, that would depict a gap in price, okay? Because if you see right here, if it closes, if the prior candle closes down here, and then it opens down here, okay, that is a gap in price, okay? So you know, usually you're going to see, more often you're going to see this type of thing, where you see a black candle, a black hammer following a black or a red hammer following a bearish move, okay? Same thing to the upside. So, but it really doesn't matter, okay? So as long as you have a very small body and a long lower wick or lower shadow, then that for me is a hammer. And you know, most importantly, it's not the color of the body in that case, not the color of the hammer body, but whether or not there's support there, whether or not, for example, there's a moving average there, there's a Fibonacci level there, there's a pivot point there, or what have you. All of that put together, that makes for a very strong trade, okay, potential trade. Shooting star. Okay, so shooting star here is the same thing, just to the opposite side. So you got an uptrend, you got a small body here, a long upper shadow. Okay, this talks about rejection near the highs, rejection, failure near the highs, and a subsequent move back to the downside and a potential move lower. Okay, so again, I don't really like to play reversals that much, but if this occurs in the form of, if you could just imagine this, if this occurs in the form of the end of a pullback. So you've got a downtrend, and then you got a pullback to the upside, okay, and then you've got the shooting star candle, and then it starts moving to the downside. I'm going to be looking for a trigger to go short in the direction of the downtrend, okay? So I'm not really looking at these as reversals. I'm more looking at it as ends of pullbacks, okay, if that makes any sense at all. It makes sense to me, but maybe I didn't answer it correctly. Explain it correctly. Gurdeep, not sure if you want to answer this now or later. What type of chart works for you to identify patterns easily? Bar, candlestick, or line? Okay, great question, Gurdeep. I'm not sure if I'm pronouncing your name correctly, but and I'm sorry if I'm not. But in terms of what's the best way to look at patterns? Is it with the bar, the candlestick, or the line? And I would say overwhelmingly so the candlestick. Okay, what is a line? What is a bar? What is a candlestick? First of all, I'm not even talking about lines. Okay, because lines don't really have a lot of information. All they have are the closing price information. Okay, so if you ever see a single line on your chart, on your price chart, you're probably looking at a line chart. okay, which means that it's only showing you the closing price. Now, if you're looking at a bar or a candlestick, you're looking at 4 pieces of information. You're looking at the open, the high, the low, and the close. Okay, on a bar chart and a candlestick chart, same thing: open, high, low, close. Now, the difference is only in the visualization. All of the price information is exactly the same. The difference is in the visualization. And in terms of the candlesticks, the visualization is far superior to the bar chart. Now, some people may disagree with me. Okay, maybe if you've been looking at bar charts all your life, okay, then you may get a feeling for them, and you may think, oh, they're just as good, if not better, than candlesticks. But for the vast majority of the traders, who are not completely used to using bar charts, the candlestick charts are very, very good at showing you a good visualization of the conflict between the bulls and the bears. Okay, so if I depicted this right here in bars, okay, you would get the same information, the exact same information, like this hammer candle. You would get the exact same information. In fact, if you saw this, you would say the hammer and the shooting star are called pin bars or Pinocchio bars. Okay, it's just another name. But, basically, you would say the same thing. It looks like the same thing, but it's much easier to spot using the candlesticks. And therefore, if I'm going to be using one chart, I'm going to be using the candlesticks, okay? It's just easier to spot things. Okay, so let's move forward. Okay, so there's a couple others that I'm showing you right here before I get to my charts. We have the bullish engulfing pattern. That's just showing you the bulls. So you have a large candlestick following a small candlestick. That's just showing you that, and in this case, it's a white or a green candlestick following a black or red candlestick, and that's just telling you that the bulls have been winning out against the bears in this particular case. And it could be a reversal signal. Okay, same with the bearish engulfing candle, but to the other side, to the downside. Okay, Harami, same type of thing, not as strong a signal. If I were to pick my signals, my favorite signals, they would definitely be the hammer and the shooting star, maybe the engulfing patterns as well. Okay. Okay, so let's go to the charts. Let's show this real quick. Gurdeep, can you build volume into candlesticks then? Do you use volume in candlesticks? Volume is, I believe, if you're talking about trading volume, that's a different indicator. It shows you how many trades occurred, or how many changes in tick occurred during a particular period. I'm not sure how you build that into candlesticks. But yeah, I mean, volume is definitely a very, very useful, especially if you're trading the individual stocks, or you're trading indices or what have you. In terms of the foreign exchange, if you trade that, there is no actual market-wide volume, and therefore, it's very difficult to do that because there's no centralized exchange for the foreign exchange, so it's very hard to find the market-wide volume. Okay, so let's take a look real quick. What I wanted to show you, I know I've been showing a lot of FX charts. It's only because I have them open, and the FX charts really show the patterns and the indicators, very well. Because, I'm of the opinion, and I've been trading all of these different markets for a long time. I'm of the opinion that the foreign exchange markets are even more conducive to technical trading than others may be, even though any market can be traded on a technical basis very well, okay, including the indices, including the indices and the commodities, and I would say that the FX or the currencies are even more so conducive to trading technically because they trade very technically, and in terms of the individual stocks, a little bit less so, I would say. Okay, from my experience, the individual stocks and shares, a little bit less so. There you've got a lot of other factors coming into play that are not as technical as these other markets like the indices, the FX, and the commodities. Okay. Okay, so what are we looking at here? You're seeing, you know, okay, Hassan, could you tell us your stochastic settings, please? You remembered from last week. Okay, I wrote it down, just in case someone asked. 25-10-5 was 25-10-5 was my slow stochastics settings that I talked about last week. Okay, and this is basically the settings I use for a couple of my strategies. It's a way to slow down the stochastics. Okay, so you see the stochastics down here. Okay, right now these are on the default setting of 14.33. But for some of my strategies where I need to slow it down and make it so I don't get as many false signals, I slow it down oftentimes to 25-10-5 once again. Okay, and that will slow it down. Sometimes it gives me later signals because it is a slower indicator. It's a slower setting, but it makes up for it in the in getting rid of a lot of the false signals. Okay, so good question there. But I would really encourage all of you to, if you're using indicators, to do your own testing on your indicators, see what works for the markets you're trading, the time frames you're trading, and for the way you trade. Okay. So really do your own research and see what works best for you. It's very easy to do a manual back test or what have you. Okay, so so if you take a look at any of my charts, you'll see patterns all over my charts. So just as a side note here, this is exactly what I was looking for. Just to talk about the currencies here, Aussie dollar. I was looking for more dollar strengthening. And then I was looking for a continuation of this remarkably good downtrend. I mean, I'm not saying good in terms of the markets. I'm saying good for the technicals. In terms of this downtrend here, we see this remarkable downtrend with this downtrend line here. We see the 50-day moving average moving along with it. We see price action, hitting its targets. Coming down, hitting its targets, breaking below those targets, trend, pullback, breakout. That's exactly what I'm seeing here. Here I'm seeing, what do you want to call this? You could call it a wedge. You could call it a pennant. Maybe not a pennant. You could call it a flag. You could call it whatever. I don't care what you call it, but what story is it telling you? It's telling you there's a downtrend. Aussie dollar is bearish. Okay, it's telling you this downtrend is looking to continue. It's telling you that price action went to this downtrend, went up to this downtrend line, got rejected from there, went back to the downside, broke down below this whatever you call it pattern. Okay, the pennant pattern, or whatever you want to call it. It broke down below the 77 support level, and it continues to go down. My target is 75. Okay, my target is 75. Below there, my target is 73. And before that happens, will we see? If that happens, before that happens, will we see moves back to the upside? We very well could. We very well could see more pullbacks, more flags, more wedges, more pennants, or whatever you want to call them. Okay, so when you see those are opportunities for potential triggers to get into trades. Okay, so here. We see over here, just on this downtrend alone, we see several different opportunities. We see this, you could call this a wedge, okay, or a ascending triangle, okay, and then a breakdown, and then here you have a flag pattern, and then a breakdown, and then here you have another, flag pattern or a rectangle, whatever you want to call it, and then a breakdown. Okay, and then here I just talked about. Okay, so they're all over the charts. Now, in terms of the head and shoulders patterns, now Aussie dollar, and I hate to keep talking about Aussie dollar. I talk about it a lot, only because it's very, very technical in the way it has been trading for a long time. Okay, so if you want to look at a very technical chart, you could look at Aussie dollar. Now, here we have this head and shoulders pattern. Okay, so this is a reversal pattern, and then here we have another head and shoulders pattern. Now, in this case, this was a downtrend, an entrenched downtrend. It moved to the upside, and then again, this was what I was looking for. After the pullback, we're looking for a breakout. Okay, back in the direction of the prior trend. And in this case, this formed a head and shoulders pattern, and then we had this neckline right here, and then we had a breakdown below there, okay? So breakdown below there. And then it moves into another head and shoulders pattern, and it moves up. And then it moves into another head and shoulders pattern. This one happens to be a very wide one, and then it breaks down, okay? So reversal patterns can be seen all over the chart, just as these continuation patterns can also be seen all over the charts. Now, just to go back and show you just prime examples of candlestick patterns that occur near support and resistance, let me show you that real quick. Okay, so this was back in the day, I know, but here we have very strong resistance. And here, what do we have? But a very valid shooting star candle. So again, you know, if you put stuff together, it'd be great. Would I, you know, if this was not resistance, would I trade off that that candle? No, I probably would not. But the fact that I've got resistance here, okay, I've got the shooting star candle here, which talks again about rejection from the highs and a move back down. Okay, we talk about the indicator moving down. Remember from last week, moving down from overbought. I'm sorry, moving down from overbought, emerging from overbought. Okay, we see all that happening at around the same time. What does that tell you? Maybe this is a good short. If it's not, I've got my stop loss. I've got my risk management to take care of me. But to me, you know, at that point, it looks to me like a good short. So you could go short there, and then over here we see another example of a candlestick pattern that occurs right along support. So we have strong support here. We have a candlestick pattern that's shaped like a hammer candle, like I just showed you. Okay, and then it gets rejected and moves back to the upside, and then here. Okay, here again, it's not only is it support here, not only is it this thing right here, this hammer candle, but it's also an emergence up from the indicator. I put all three of these together, I get confluence for a potential long position. Okay, this could very well have occurred on, this occurred on the daily chart. It could very well, something similar could have occurred on the hourly chart or the 4-hour chart or the 15-minute chart or the 30-minute chart or what have you. Even the 5-minute chart, okay? Okay, so let's take a look at some other, I think I'm running out of time here, but let's take a look at a couple others. Here on the euro dollar, you know, this euro dollar just was just an amazing move to the downside, okay? So after it broke down, well, I mean, this whole time, we have this, this very sharp sort of parabolic, downtrend all the way up from back here in May of last year. And then, you know, starting at a certain point, I forget where it was, I started looking towards a downtrend, okay? So it was maybe somewhere around here. Started looking towards a downtrend. Ever since then, it hasn't, Eurodollar has not disappointed. Okay, so it's had many different technical moves, including breaks of patterns, etc. And this one was just remarkable. Okay, so we have this sort of triangle pattern here, and this could be deemed a symmetrical triangle pattern. Okay, so then it broke down below there. It hit my target 111. After it dipped below 111, I was looking for 108. Okay, so this was on my analysis that I post on City Index. So it goes down. It hits 108. After that, my target was 105. Okay, it just hit 105. Now, what's the target? You know, everyone's talking about parity. You know, sure, why not? Parity on euro dollar. I haven't thought that far ahead yet because these targets have been hit so quickly. You know, I was expecting a little bit longer, it to take a little bit longer to hit these targets, but it hit them. And now it looks like we may be going towards parity, which is 1-to-1 on euro dollar. Okay, pound dollar, also a remarkable move. I talked about this today. Actually, I wrote about this today. It was at 150 support, and finally it broke down below there. I was looking for 148 for quite some time. 148, I think, should be hit pretty soon. Okay, let's take a look real quick at some indices. Okay, so this is a really messy chart. Okay, there's a reason I haven't been talking about the the FTSE, the UK 100, for a while, is because this is a really messy chart. There's not a lot that's going on that's really technically reliable here, other than the fact that it broke out, recently above this resistance level, but then it, a sort of fake breakout and came all the way back down and now just dropped to the downside. A really messy chart there. But if we take a look at a lot of you like to trade the Germany 30, which is the German DAX, okay, which also oftentimes acts very, very technically. Okay, so we take a look here, and it's still on a tear. Okay, in terms of the upside, it's just been remarkable. But here we see very strong resistance here on this triple top. Okay, so this triple top was a triple top because it turned out to reverse that trend. However, it came up here and it came to hit another top up here, came back down, and finally broke through. That could be a trigger of a break of resistance. Okay, a break of resistance. And here we sort of had a double bottom here. And then here on a larger scale, we had sort of a head and shoulders pattern, okay? And if you want to draw that, you could draw it, the neckline very easily there, okay? You could have taken that. You might not have taken that. You might have taken the breakout above this resistance level if you were bullish on the German DAX. Okay, let's make this a little bit bigger. Now, if you take a look here, you take a look at these candlesticks also helping this along. You take a look at this very nice hammer candle right down here, right around 8,500 support on the German DAX. Okay, and then you see whenever you see long wicks or long shadows, that could be a sign of indecision in the market or failure or rejection, and that can only help your case. Okay. Let's take a look here. Here we have a little consolidation pattern, whatever you want to call this. If you want to call it a triangle pattern or a broadening pattern or whatever you want to call it, you take a look here and you see what do we see there? But something that looks suspiciously a little bit like a hammer candle. Now this is not a classic hammer candle, but it shows that this consolidation price action tried to pull back more, but then there was a subsequent move to the upside. Okay, so yeah, I think I've run out of time here, and what I'll do is I'm going to wrap it up right now. Again, if you have any questions whatsoever, please feel free to email me at james.chen@cityindex.com. I'm always available for your emails, and hopefully I could see you next time where we're going to talk about multiple time frames. Also on Monday, I'm going to be giving you some analysis right about this time, 8 o'clock. Okay? So I would like to thank all of you for your time today, and I'll see you next time. Thank you very much.